All right, everybody, how we doing out there? Doc Severson with you here. Trade School today is the 27th of September in 2019, and it's been an interesting week, has it not? So the move that we've been expecting for quite some time has finally showed up, and it's always one of these things where you just don't know when it's going to happen, but when it finally does, it's a little shocking when you see the move. And I've seen these things so many times, they're impossible to time. So if you wanted to be on board for something like this, you had to be in it to win it. You had to be already on board. There's no way to join the market when this starts moving like that. So let's see how we're doing here. See how everybody's doing here. Okay, so give us a shout if you are live and if everything is working okay. Otherwise, most of you are going to be probably attending this through the replay. So welcome aboard if you're on the replay, wherever you are. Okay, so today let's get into things here. We're going to go over a couple of different topics today with Trade School. Okay, so I've been asked to talk about option strategies for BTC. Talking about Greeks on Deribit, which we went over a couple of weeks ago, and I don't really have much new to say about that, although we can talk about what we can do on a different broker. So I can go over to my TD Ameritrade Thinkorswim platform and show you what we have available over there. Now, the purpose for doing something like that is for you to see what's already been happening for the last, 30, 40 years on the equity markets, which I believe will eventually transfer over to the crypto markets. So as long as we have volume, as long as we have brokers that can make money in this space, they will continue adding features. We will continue having competition, and it's going to be one of those things that ultimately is better for the retail consumer. Okay. And also what I wanted to do, I haven't done this before, but at the very bottom there is, I want to show you something that is a free tool available for you. And if you are doing any kind of trading, any kind of scalping, any kind of futures trading, is something that you really got to do, which is to do replays. So replays and repetition and practice, so you're not spending your money to learn how to do something like this. I'll show you how to do this with NinjaTrader. Okay, any questions before I get started here for those of you that are live? Anybody out there? Okay, so let's get into it here, and if you guys have anything you want to bring up, let me know. So remember the 4 business cases that I made that options traders can pursue. So I tried to explain this a couple months ago when we brought up the options course, that there's really 4 different business cases that options represent, whether or not you're short or long, puts or calls. So we talked about the insurance buyer. So somebody buying insurance, protecting against the downside, is somebody that is trading long puts. Somebody that is selling premium would be selling short puts or trading short puts. Okay? A speculator bidding on the forward price of an asset thinking that it's going to go higher is typically going to be trading long calls. Trading long calls. And then if we flip that around, if you're already an asset holder selling premium or renting out your crypto, you're a landlord, and that's the short call trade. So there's only 4 trades that you can do right now. You can long puts, short puts, long calls, short calls. And so for a lot of you, this may be the first time you've ever sold something to open. It's a very unique experience, and it will catch you off guard for a while because you're used to buying something. So I still have people that are reaching out to me to say, hey, how do I sell this position? And they're trying to close the position, but you have to buy it back to close it. So when you trade options, it forces you to become a more complete trader because you truly understand short and long. All right. Don't see anything in the chat today. I don't know if there's a problem with the chat. So if there are any questions, make sure that you post something in the chat to let me know. Okay. Long calls are a very low probability method of using your capital. However, this is typically what people like to start to teach you about, which is a long call is a long proxy for the leverage, long proxy for the asset. Well, that's true, but it's something that it's the analogy of holding an ice cube, getting closer and closer. Oh, okay, so we got a couple of people alive. Okay, super. Thank you guys for checking in. I never know. I feel like I'm talking into an echo chamber here. So a long call is that classic analogy. You're holding an ice cube and you're getting closer and closer and closer to a roaring fire. And what's going to happen to that ice cube? The closer you get to it, which is representing expiration, the more it's going to melt. Long puts are also a low probability. They're a selective use case. So if you're bearish, I wouldn't be trading long puts because more than likely you're already too late to enter it because there's so many things you have to get right. You basically, if you're going to trade a long put, you've got to be on the position before the price breaks. And how many people are on the position before the price breaks to the downside? Next to none of them, right? It's a very difficult trade to enter and get right because usually the conditions are fairly bullish right before a price break to the downside. Next one here, the better strategies being short puts and covered calls. This is really what I went over in the course, was to show you guys how to set up short puts to begin with and then covered calls. Some of you found out this week range contraction leads to range expansion. So this is why I haven't been doing anything with the trades lately, because when the price is doing something like this, one of two things will happen, and both of them are violent. Either we're going to get a huge upside break or a huge downside break. And what I was saying over the last few weeks is that because of the fact that everybody's looking for an upside break, I mean, it's a 94% chance that the price is supposed to break higher from a symmetrical triangle. I felt that too many people were looking for it. I was looking for a downside break, which means that I don't want to sell puts and get run over. So some of you sold puts, got run over, and risk management. Now all of a sudden you're going back over the lessons that I talked about and saying, oh, so that's what he meant by rule number 1 of risk management. It is difficult. However, if you wait for the trade to come to you, this is where you can get maximum edge. You can use that spike in implied volatility to your favor and get something that's way out of the money down here. But you got to wait for it. You can't get impatient. Let the trade come to you. It really helps to sell into the big moves when it feels least safe to do so. It really doesn't feel very good to sell into these. Okay, so those are the 4 different types, and this is really, again, what I think that you guys should be doing is start off by selling puts, get assigned, get some BTC, although I realize that with Deribit it's cash settled, so if you don't win the trade, they just take BTC away from you. But if you've been listening to me, trade small, trade small, trade small. And even if you do get run over, it's not going to be that big of a deal as long as you honor your exit. If you stick your head in the sand and say, whoa, I don't want to lose, it might bounce. Okay, you're going back and doing the same exact thing that you were when you bought the spot.
Here are the top search results.
My phone just woke up. Something I said just woke up my phone, and I don't know what I said to do that. I'll try to find out what I said and not do that again. Okay. That just completely took my train of thought away. If you're going to sell calls, you've got to do the same thing. You've got to wait until you get a fairly substantial move to the upside. Otherwise, what you'll find is you'll be surrendering your Bitcoin. You'll be surrendering your Bitcoin because if you get one of those really big parabolic rallies, you're going to be selling this strike. The price is going to be up there. And you have to sell it at the price down here, which you're not going to want to do. So you can do one of two things. You can either close this position and roll it further up. That's potential, but you'll do so at a small loss for that. The NSA is listening. Yeah, there we go. So one of the questions that I got that came in was, what do we do with Greeks on Deribit? And again, I refer you back to the presentation I did on 2 weeks ago, the 13th of this month. And so what I will do is, if I can find this here, I'm going to swing over Deribit. In fact, I think I'll just swing over this. Yeah, there we go. That'll do. That'll do, that'll do. So let's go full screen on this. Now, what you have to understand is when you look at the option chain, it doesn't matter which one you're looking at. Doesn't matter which one you're looking at. You can add right up here. You can say, what do I want to look at? I want to look at the last price, yes or no. I want to look at implied volatility. Now I'll get to that in a second. I can look at volume for these. The volume is going to be in terms of actual BTC. I can look at open interest. Open interest is also going to be in terms of BTC. These are people that have current positions that are on there. So right now on the 25 October series, we have, in terms of the calls over here, we have 146 BTC worth of call options sitting there on the 8,000 strike. So somebody's buying something. So those are currently open positions. Delta. So this is the only Greek that's available. The Delta shows a couple of things. First of all, it's the value of the next point move of the underlying. So how much is the option position going to increase or decrease in value for the next point move? It's also a proxy for probability. So this is typically more useful for something that's out of the money. So in other words, what the market is saying, and this is the market, this is the market based on activity, based on the implied volatility and everything else that goes into this. Let's say if we go up to the $12,000 strike, the probability that between now and 25 October that the price will be back up to BTC 12,000 is 8%. 8% probability. Okay, so let's highlight this here. This is an 8% probability. So you can use delta as almost a proxy for probability of success for a trade, which is interesting. I mean, find something else that you have that's out there where you can look at something and the market itself, based on the activity of everybody trading it, is generating a probability for something. This is one more thing why options are fascinating, because there's a built-in sort of sense of timing to it. There's a built-in sense of what the expected move might be. So a lot of people that are brand new to trading will sit there and say, oh, look at this. I can buy, if I buy this option, this call option up here, and if I spend $70 on it, so somewhere around in here would be about 70 bucks midpoint. And if the price gets up to between now and October 25, somewhere in the next month or so, if the price gets up to 12,000, then I can sort of presume that that $70 option is going to be worth, somewhere in this order, is going to be worth like $780. Now that may not make a lot of sense until you start working with option chains. Like right now, the at the money is about 8,000, right? So if the price rallied up to 12,000 up here, then these options, which are priced about 70 bucks right now, these call options would be worth about 780. So that's a massive return. That's a 10 bagger. Okay, so a lot of people look at that and they say, wow, that looks really great. But understand that the market's only pricing in an 8% chance of doing that. So talk about a home run trade. This is a home run trade. This has got a very low probability of success. But if you do hit it out of the park, wow, I mean, that's a massive trade. So you're going to be telling everybody at parties for the next 10 years if you did something like that. Unfortunately, you will hardly ever replicate that. You'll spend $70, $70, $70, $70, $70. Eventually, you'll go in the red trying to replicate that success. Trust me, I know this, because that's the way I learned how to trade options to begin with, was to buy calls as a proxy for the underlying asset. So this is one way that you can use delta for this. Now, unfortunately, there's no gamma on here. Gamma is a second order derivative it's the first derivative of delta. So it's something you don't really have to worry about that much. It more goes into different strategies when we go into either long or short gamma strategies. It also affects things around expiration. So gamma around expiration actually does this kind of thing. Here's the current at the money price, and maybe this is gamma. This is the effective gamma around the option price. Well, when we get out to expiration, it does this kind of thing. It makes a huge difference in the delta of that option, and hence, therefore, the value, how much it changes, how much the delta changes, meaning how much the option value changes right around the price. So what you get is you get these wildly whipping values right around expiration, which is not something that you want to do. So the other thing that's not on here is theta. So theta, I think that's what theta looks like. It's been a while since I've done all those funny little Greek symbols. But theta is the amount of time value decay that the option suffers or enjoys, depending on whether you have sold it or bought it. And that's not on here as well too. Now, again, theta is something where way out, it doesn't do much, and then all of a sudden as you get closer and closer to expiration, it's almost, the knee is very quick on that graph. So it really dives down. So we don't know what theta is, and quite honestly, you can estimate it because all of these options are out of the money. So this is all premium. This is all time value on these. And you can sort of do a linear, you can just sort of assume that, okay, so this option, we've got how many days here? We've got 27 days, and it's not going to be linear. It's not going to be doing something like this. So probably for an option like this, that if you actually went out and bought this thing for 1 BTC's worth, and if you paid somewhere like $420, it's not going to drop 10 bucks a day, which is $10 or $12 a day, which is what it would be if it was linear. It's probably going to start out at something like maybe 4 or 5. And then by the time that it's getting closer and closer to expiration, it may be dropping $20 a day, something like that. So do we need that? Not necessarily. You just need to know which direction that it's going for you. If you bought an option that you know that you have a negative theta number. If you sell an option to open it, you have a positive theta number. The position is gaining value to you, the seller, with every day that it goes by. Now, the last one I haven't talked about is implied volatility, which is here. This is not a Greek. This is not the Greek. This is the actual implied volatility of the option. I wonder if they have a definition of this in terms of how they measure it. So this is the actual, let's see if they probably have a help file out there which will explain whether it's a 30-day or whether it's an annualized volatility. But this is basically what it's saying is that between now and the period that they measure in, and I think this is annualized, that this option value could be plus and minus 136% of its value within the life of this option. And we typically, well 90% is pretty big. In the equities market, we typically see implied volatility values from 10 to 15 to 20%. Now, this by itself, these numbers are not that useful to me. So just looking at this and saying, okay, it's 92% volatility. Is that high or low? I don't know. And so if I'm a seller of options, what I want to do in a perfect world is I want to wait until implied volatility spikes. So I'll call this IV over here, implied volatility. I want to wait until it spikes, and then I want to sell at that point. I want to sell big volatility, and then I want the volatility to come back in again. Because these positions that we're selling are short volatility. What that means is they want the volatility to go down after you enter it. And right now, I don't know of a way to graph this to know whether or not, and I'll show you something in a minute here, which goes along with the TD Ameritrade, where we can see kind of like, is it high or is it low? And right now, I don't know. And so a lot of people I know that are experienced option traders are actually going out there, and I think Checkmate is even doing this. They're going out there and actually capturing these values. They're sort of taking a snapshot once a day and they're just tracking this sort of stuff. And that's an awful lot of work, right? It is, because it's going to be different for every option that's out there in the chain, and it may not be the one that you're trading is the one that you find. So these are the Greeks. These are the Greeks with options. And quite honestly, a lot of these are not that useful for you just yet. So I think it's useful, to me, the delta is the one that you got to know. You got to know whether or not you have a long or short delta position. A long delta position is one that makes money as the price goes up. So that would be a short put, or a long call is going to be a long delta position. And then a short call or long put is going to be a short delta position that makes money as the price goes down. Also, the proxy for probability I think will be useful for you. So if you're selling something, if you're selling a put that's out of the money here, you can see that the 7,000 put for 25 October has got a 27% probability that the price will be at the money by expiration. And that's another way of saying that's a 73% chance of success if you've sold that $7,000 put, that it'll be out of the money. A 6,000 put right now is showing a 14 delta, and the converse of that would be that there's an 86% chance that the price will be out of the money still or above 6,000 by the 25 October expiration date. Now, how accurate is this? I don't know. I don't know. This is the option market based on all the calls and puts that are being traded, coming up with this number for you. Okay, so let's do this. Now, what I want to do is I want to transition over to, I'm going to bring up my TD Ameritrade account and show you some of the differences. And I'm not going to bring this up to you just to show you, well, first of all, if we go to the S&P 500 or the SPDRs ETF, which is one of the most actively traded instruments that's out there, look at this. Just today, there's a volume of 13,000, almost 14,000 shares traded with this. If we look out at options that are expiring today, if I look at volume and open interest, the volume of these call options, there's 14,700 of these that have been traded today. There's currently 9,500 of the 297.5 calls. Look at how deep these markets are. Notice also the spread width in these. The spread width of these is like a penny wide. It's a penny wide on Okay, look at this, a penny wide. I mean, these are just crazy liquid markets. I mean, just massively. So these have been around for the better part of 40 years now, these option markets, and they've continued to get deeper. They've continued to compress. Now, in terms of the volatility, let's go out to something like this where we're looking at, I think it's this one right here. Now, what I can do is I can look at, let's see which color is which. So the implied is blue, the historical is the orange. Blue is implied. So what this is showing is I've got a number for relative volatility. This is looking at the money options and showing the current implied volatility, and it's graphing it out here. So this is something that I kind of wish that we had for Deribit or anything to do with BTC options, which is not there yet. You can probably find a way to graph this if you do data collection every single day and do this, right? So that's possible to do. That is possible to do. And what's always important is like the pink line or orange line, whatever you want to call that, that's the realized volatility. So we have an edge when we're sellers when the volatility peaks like this, as you would assume when we have a sell-off like this, the implied volatility peaks, but then it contracts again. Notice how it contracts again after that, as does, well, the historical volatility increases, but it's a trailing number, right? It's an average. So averages are always trailing, lagging indicators. So this is an area where we want to be selling into something like that. Notice that you're selling into the fear, and then the fear collapses after that. But you can't do it too early. You can't sell up here. You got to wait until you fully get that big spiky move. Something else that I've got on here, which is a tool that I've got, is the percentile. This is the implied volatility percentile on a scale of 0 to 100 over the course of the last year. Where does it fit into? So you're going to have a histogram, right? So there are going to be some days that are going to be 100 percentile, some days are 0, most of them fitting into a bell curve somewhere in the mean. Right now, we have 17 percentile because over the course of the last year, we've had some big spiky. So here's the hundreds, and this is probably 90 percentile. But right now, we're down to 17 percentile. That means that on a relative basis right now, we have relatively low implied volatility. Yeah, Deborn is saying you could write a script to do it. That's, you know, I am not a programmer. I am not a programmer, and that would be an awfully good skill to have right now because there's just the amount of data that's out there that we have to process and go through is just almost mind-boggling. And if you're able to scrape this stuff, pull it off, scrape it, download it, whatever you want to do, export it, pull it into something, and then graph it, this would be awesome. So a lot of people, you know, keep your eyes peeled because some smart enterprising people will probably do something like this and then throw it up online. So these are some of the tools that I use right now in the equity markets to be able to understand on a relative basis, is the implied volatility relatively high or is it relatively low? If it's relatively low, I'd like to be a net buyer of options because it's only going to get higher from here, or it's statistically more likely to increase from there. If it's super high, it's statistically likely to revert back to the mean, and that's where I want to be a seller. So having tools like this would be terrific if we can get to that point. And I am anticipating that at some point we're going to get tools like this in the options market for crypto. Okay, any questions about this? Before I move on. Now, one thing I wanted to do today, and I haven't done this before, and I tried to figure it out, but I'll have to do this. I'll have to save this for the next time. And I'm not going to be here next Friday because I'm going to be going under the knife apparently. So they're going to open up my knee. It happens. It happens. The meniscus breaks and they got to go in there and dig it out. So next Friday I'm not going to be around, but what I want to do is I want to, some of you were asking about contingent orders. So a contingent order would be something like this, where if we have something on the price chart, if you had sold a position down here, so maybe you got a position that's right here, and maybe you sold that put, right? You sold that put and you're like, okay, as long as the price stays above that put, I want to stay in the position. If it gets out, if it starts to undercut this position, then I want out of here. Then there are contingent orders that you can set up with more of the advanced brokers. Now, there's no guarantee that you're going to get what you want out of this, because typically a contingent order means that wait until you define a price level at which it fires off a flag. And so it sets a condition to say, okay, I'm going to wait till the price undercuts 29.40 and then, okay, get out. So it's going to set the flag, and then from the flag you're going to define what type of exit you're going to set. So whether or not you're going to set a limit or market or whatever you're going to do. The problem with a limit is you don't know what the price of that option is going to be when it gets down there. The market is going to be able to accommodate that, but you don't know, you're going to lose some edge on the order when it comes to that. So I don't do those though, so I tried to figure that out like 5 minutes before today's trade school. Was not able to do that. So if I can figure that out by next week or the week after that, I will do that. Okay, let's see what else that we have set up for fun today. And guys, let me know if there's any questions as we go through this. Okay. So we did Greeks on TD Ameritrade. Oh, Ninja Trader simulation. Okay, so this will be fun for you guys. So let's see if I can figure out where everything is. Now what I have here is a chart. So let's go ahead and pull up the chart. And let's go over here, and with Ninja Trader, and Ninja Trader, I've got a bunch of these things set up. Let's go ahead and set up the connection. Okay, let's go to playback connection. And I'm just going to do something like, let's go to Tuesday or something like that. Let's go to yeah, there we go. So let's go to the Tuesday after the market open. And so what it's going to do is I've actually collected this data, and it's free. You can download Ninja Trader for free. You know, you'll get some emails. I mean, it's not that bad. But you can also download the playback data for free. It's, you know, a day late, right? You can't trade it. But what you can do is, what they're trying to do is they're trying to get you hooked on the platform, and it's actually a very nice platform to use. Okay, and what I will do is I've got a little thing called a dynamic superdome here. And let's zoom this out. Okay, and what I'm going to do is, so if I were to trade this, typically what I like to do is I'll do something like this, is like I'll define the opening range. And look, I realize this isn't crypto, but again, kind of one of the themes of today is like I want to show you guys what's out there and what may be coming to crypto at some point. When crypto becomes more adopted, more mainstream, we're going to get the same types of tools. So what I like to do is I like to trade, I like to at least map the opening range. The opening range is the first half hour of this. And let's see what we got. Okay. So I'm just real particular about these sort of things. So this is, I'll fill this in, the opening range for this. And so let's see, we got this over here. I'm going to go ahead and do this 2 times. I'll play this 2 times just because we don't want to have to wait for this. And so what I want to do, let's see. Okay, we've got this. And I'm going to start putting in some trend lines here. Okay, so this is what I typically do. And you can start to see the price. And also, oh, by the way, I've got other charts up here, which are the larger time frames as well too. So I've got the 25x and I've got the 5x charts over here as well too. And you'll recognize the RSI Laguerre on these. Okay, so this is the 1x chart I'm looking at right now. And so what we're going to do is we're going to look for some opportunities here. Now this might be a, let's see if I can find this guy here. Here's my Superdome. I think this looks like actually a trap because there's a higher low, and if this breaks above here, this may be something that I might want to take. Okay, so there we go.
Order submit, order filled.
Okay, so what we're going to do here is, here's my first target, which is this green one. Here's the entry price in the brown. Here's the current price of this. And my stop is way down here, like there, okay? So if I scroll up, you can see where my second contract target is. So I'm just gonna sit there and see if I can get this one to take off the first target, then I'll move the stop up. But this is what trading looks like. And this is a way to practice this. So again, I've run this up like 2 times. So I don't know what's going to happen here.
Target filled.
Okay, so we just got our target filled. So what I want to do is I want to bring up the stop to break even, which is actually kind of aggressive. This increases the chances that I may get stopped out if it pulls back to here. But let's see if we can, let's go ahead and expand this out so we can see it a little bit better. So our shot is asking, is there a way to know at what level a position is going to be liquidated in Derivate? If you're worried about liquidation, then the position is too big, or you're taking too much risk, or your account's not big enough. So that's not a great way to answer that question, but it's you know the real thing here. So we got the second contract. So let's go ahead and pull the stop up here to 82.50. So I'm going to bring this stop up to 82.50. I'm going to protect some profits in this trade. And so we're going to see if we can get the second contract off here. So the worst case is the price comes down to 82.50 and then we don't get this one. Or we get at least a little profit from that. Okay. And the further up that this goes, the more you want to kind of choke the noose around this thing. So I could, if I wanted to, bring this up to like 86.50, which is right around here, and not let this drop too much further. So Deborn, I'm brand new to options. To trade options, do we need to be in front of the screen to be effective? No, you don't. You really don't. And in fact, the way that I teach the trades for the swing trades we set up for the short puts and covered calls really doesn't require you to do much of anything. But you got to be there for those entries, and you have to understand when to do something. So this is where you have to, like, if you define an exit point, you've got to get that on the chart. You've got to find a way to alert yourself, because that's the problem here. The market's open 24 hours a day. And again, this really goes to the point where you need to be trading small. Okay, so I'm gonna raise the stop up to 83.25. There we go. So we're gonna protect just a little bit more profit. Looks like it's coming down again. And I may get hit.
Stop filled.
Okay, so I've been hit. So that's the first trade here. That is the first. This is there's the higher low. Here's the higher high. And sometimes you can get a hook that goes along with this, but this is a trap entry. So there's a TRAP, trap entry. Okay, so let's see if I can get the second entry. So after the trap, there's a second entry, which is the hook entry. So what it looks like is maybe like an 83.50 or so, an 83.50 entry. A lot of times these will, I've got this set up at 2 times. Okay, so I'm just going to, if it breaks above 83.50, I'm going to get the hook. I want to wait for that hook. But if it breaks above there, then I want to go for it. Okay, so there we go.
Order filled.
Okay, so I'm in just a little late. And let's see how much I'm risking on this. Okay, so 80.50 is the recent low. Okay, it's back to break even. It's up slightly. So my stop is all the way down at 78, which is fairly low. And you'll see this volatility, so it's important if you're day trading. Day trading is when you do have to be here for something like this. If you're scalping futures, this is no different from Bitcoin. Although the NASDAQ futures are going to be a lot faster, a lot more volatile than Bitcoin is. Bitcoin, you occasionally get these big blasted movements, right? But okay, we're just about there.
Target filled.
Okay, target filled, so I'm going to bring up my stop to break even for the second contract, which again is quite tight. Sometimes that'll take you out early. And now I can start to move up my opening range. Do you see this? This is the second entry. Here's the first entry, which is the trap entry. Second entry, which is the full hook. Okay, there we go. Okay, so I can raise my stop now to about 86.5. Should be okay to raise the stop up to about 86.5. Protect some profits on the second contract. And this is how you make a day, as you do things like this. Is Ledger leverage for options, or is it 1-to-1? I believe the minimum position size is 1 BTC, so I don't think that they have leverage on those. Although there is, there is leverage to that, because obviously if you're trading, you're going to be able to buy a call option, or you're going to be able to buy some option, which is going to be a fraction of the cost of.
Filled.
Okay, so stop filled. So we did a couple of trades here with 2 contracts. That's 265. For most people, that's enough to finance another day's worth of food. And this is how you can make your nut every day in the market. So was it perfect? No. I mean, this thing may actually take off and make me think that my stop was a little too aggressive, which is the case. But again, this is not bad for simulated, right? This is a replay. You can do this at any time of day or night. So if you're time restricted, you can kit your skills, because what you have to do is, if you're going to be trading futures, you've got to get the repetitions in. Okay, so Arshad, risk is not an issue since I've taken a decent position and have the cushion of account size, but just curious. I saw this feature on BitMEX, but don't find it on Deribit or Ledger. So Deribit, if you look at Deribit, they've got initial margin and maintenance margin. So right now, my initial margin, since I have 2 positions and they're real small, is 11% of my account. So I've got 89% of my account left. So this thing could really, now I don't know what the actual liquidation price would be for something like this, but I'm never going to find that out. I'm not going to hold on to this thing. I'm not going to hold on to these positions if BTC goes down to 3,000. I've got a very specific exit defined for these, that if it goes below there, I just get out. So this is the thing that you never want to get caught doing with options, is letting your liquidation be your stop. Why would you do that? If your liquidation is your stop, then you basically have defunded the entire account. You've overtraded because you're gambling way too hard with something that you don't have, and then you got to start all over again. And that's just no fun. I mean, everybody has gone through their days of blowing out accounts and things like that. But don't do it on purpose. I see other people that are around on the internet saying, oh, the way to set up an ideal risk reward is to use liquidation. Well, you can maybe liquidate that position, but based on the size of your account, I mean, wow, that's a really aggressive way to do it. So keep things small while you learn. You know, you can always go bigger later, right? But this is what's in Deribit. I agree with you. I haven't seen anything like that in Ledger. Okay, I think that's all the questions. So Ledger requires 1 BTC per position. That's a minimum position size. So they don't let you do, you know, sub-integer contracts. So Ledger is just kind of difficult to use right now. So even though it is the only US sanctioned, CFTC sanctioned options broker for US people, it's just not a great option until they get more liquidity on there and allow you to negotiate between the bid and the ask. It's a great platform for them, but not so much for the retail trader. Okay, any other questions? So that's NinjaTrader. NinjaTrader is free. You can do all of this stuff in NinjaTrader, and it allows you to do free replays. So if you want to get better at this thing, so to me, this is just a price chart. A price chart's a price chart's a price chart. I don't care what it is. I don't care what I'm trading. They're all the same. They all move in the same manner. These are tick charts. So this is important, is that I'm using tick charts here. So there's different types of candlesticks that are available. Now, TradingView doesn't do this. A tick chart means that every candle in this case is 275 transactions goes by before it builds a candle. And then another 275 go by, and it's just going to build a candle based on the open, high, low, close data for that. What you end up getting is much more pattern-based trades, pattern-based charts, I should say, with tick charts. Again, this is not something you can do with crypto, because right now for crypto, for 275 transactions, that would be a lot, right? That would be a lot, and the market just doesn't work that way. It could do it that way, though, with futures contracts. So for every futures contract which is traded, they don't have to go through the whole transfer routine, right? Like they do with spot currency. So it could be done with futures contracts. And I just get much better charts with something like this that show this sort of sawtooth type of pattern, which to me is much easier to trade based on my eye. Okay, guys, that is all the material that I have for today. Those are the questions that I had coming in, and just some of the things that I thought might be useful to you to trade along with. Let me know if there's anything else that you want, or any other questions in the next minute or so here. I'll just sort of hang out and see if there's anything. I know that there's like a 30-second delay. So if there's any other questions, I can do that. Otherwise, I will wish you guys a good weekend. Yeah, I mean, this is interesting. Like if we go out to the upper chart, you can see this is a good example of like, here's the 25X. We want to be trading in the green candles. These are Heiken Ashi. So you want to be trading green candles if you want to go long. And you also want to be trading the positive momentum on the 5X as long as there's energy here. And so you can see that you couldn't see these, but this is why I was taking the longs here, is that we had good signals on the 1X, but the 25X and the 5X also supported the trade. Okay, guys, I think that is it for today. Thanks for hanging out with me here Trade School here at ReadySetCrypto. Hope that made a little bit of sense to you guys. And again, I'm always open for topics. Love to help out. So thanks for hanging out today. You guys have a great weekend, and I will see you mañana. Take care.